Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Let's talk about something that's a little bit dull, but something that affects many more of my customers as they get older and start to develop some investments, and that's cost basis. And specifically what I'm talking about here is what is it you need to know at tax time? What am I talking about here? I'm talking about selling an investment. And when you sell an investment, there is a tax consequence. Now, one of the things you're going to need to know is whether you have a capital gain or a capital loss after you sell it. You need to know what your cost basis is in that. So if you hear accountants talking about cost basis, basically for stocks and bonds, the cost basis is generally the price you paid to purchase the securities, including purchases made by reinvestment of dividends or capital gains distributions, plus other costs such as commissions or other fees you pay to complete the transaction. Now, most of the time, this information is found on a confirmation statement that your broker sends you when you purchase a security. Now, here's the thing you need to know. The IRS makes you, the taxpayer, responsible for reporting your cost basis information accurately to the IRS. Now, where is this done? When you file your tax return, most of you may remember the form Schedule D, but now in 2011, they changed that to Form 8949. Now, you don't have to fear this, though. When it comes to computing cost basis, in 2008, Congress passed a law that requires brokerage firms, mutual funds, and others to give you a hand. So let's talk about, what the brokerage firms are responsible for doing and what ultimately you're responsible for doing. And this is important because I meet with so many clients who may have sold something, a stock that they inherited or something like that. And I'll say to them, okay, let's talk about cost basis. And they look at me like they have no clue what I'm talking about. So this is something that's important. So in its cost basis reporting, frequently asked questions on the IRS website, they lay out what information brokerages and other financial institutions must provide with respects to cost basis reporting. Now, these are the general rules, and that is currently brokerage firms must report cost basis and the type of capital gain. What they mean there is short-term or long-term, and that's important because there's different tax rates based on whether something is short-term or long-term. They report these to you on Form 1099-B or some substitute statement. Now, this includes shares of corporate stock that you acquired after 2010, shares of stock in mutual funds acquired after 2011, shares of stock acquired in connection with the dividend reinvestment after 2011, and certain other types of securities such as debt instruments and options acquired after 2013. That would be like corporate bonds or municipal bonds or things like that. If you sold any of these things in the previous year, you should have already received a copy of any 1099-B or substitute statement from your brokerage firm. Now, what I tell my customers who are actively involved in investing, you're going to want to wait to do your taxes till at least after February 15th, because that's generally the deadline that most brokerage houses have to get this information out. Now, I will tell you in practice, though, I would tell you probably to wait till March 15th, because I've seen so many times when the brokerage houses will make corrections and then I have to file an amended return. Now, the key thing, though, and this will go back to a discussion I had not too long ago about W-2 forms, is as soon as you get that 1099-B, look at it. Make sure that the cost basis makes sense to you. Now, there are situations, however, in which a firm may not have been required or simply unable to provide that cost basis to you. Now, these would be situations such as, if you bought stock many years ago. I had a client in today that had bought stock back in 2005, and there was no cost basis information listed because, quite frankly, for several reasons, not the least of which was it was old. It was probably passed from broker to broker, which is another thing, if it's transferred between holdings from one securities firm to another. So if you have questions like that, what you want to do right away is contact your financial professional and have a discussion with them and talk about, how can I get this cost basis information? Now, in general, you have a few choices how you want to handle this cost basis. If you purchase shares of the same company or mutual fund at different times and prices, you have a choice when it comes to deciding which shares to sell for the purpose of cost basis accounting. And what we're talking about here is specific share identification. Now, if you can adequately identify the shares you sold by keeping careful records of which shares you bought when and how much you paid, then you can use your cost basis to identify those specific shares. If you cannot determine exactly which shares you are selling, or you don't wish to go through that bother, and that can be quite problematic, you can calculate a gain or loss as if you're selling the earliest acquired shares first, like what we call a first in, first out method. Here's how that works, and I'll give you an example. Let's say you sell 200 shares of a 2,000 share portfolio that you purchased over time. With FIFO, or first in, first out, the IRS expects you to use the price of your oldest shares, the ones you purchased or otherwise acquired first, to compute your cost basis. Especially for buy and hold investors, the oldest shares often wind up being the least expensive, resulting in a lower cost basis, thus a larger tax bill. Now, for a limited type of sales, including those involving shares of mutual funds or shares of stocks obtained through a dividend reinvestment plan, you might also be able to elect the average cost method as a way to figure your cost basis. Now, you can find out a lot of information about that on the IRS website, but basically it works like this. Let's say that you bought, 200 shares at this point, another 200 shares at this point, another 300 shares. You would have a total of the number of shares and divided by the total cost would be your average cost basis. Now, it's a good idea to contact your firm or financial professional before you sell these securities so you understand, what that cost basis is going to be for two reasons. You want to make sure that, first of all, the brokerage house has that information, and secondarily, you want to understand what the impact of that is. What is the tax impact of that? And the reason that's important, and I'll give you a really quick 1, 2, 3 on that, is if you sell stock that has capital gains, you might ask your broker, listen, let's say your broker's name is Bob. Bob, do I have anything in my portfolio that has capital losses that can offset against those gains? So that's why it's a very good reason to talk to your broker. Well, let's wrap this section up with 4 record keeping tips. Now, it's important, even though the brokerage houses are, mandated by Congress to do this, it's important to keep good records of your transactions. And that's because ultimately the IRS is going to hold the individual investor, not the financial institution, responsible for accurately reporting cost basis. So here's some tips. Number 1, hold on to trade confirmation showing how much you paid for specific shares and file them as an easily accessible place you can find them come tax time. That's particularly important if you're going to use that specific share. The next thing you want to do is keep track of stock dividends or non-dividend distributions received because they can affect your cost basis. Number 3, this one's really important. If you receive the securities as a gift or through an inheritance, you may have to find out the fair market value of the securities when they were given to you, or you may need the previous owner's adjusted basis. So, for example, let's say your Aunt Harriet died and you got 800 shares of Apple stock. First of all, that's great. But if you did that, you'd need to know what's the value of that stock on the date that Aunt Harriet died, because you get something called stepped up basis. So whatever the value of those stocks were on that day, that would be your basis. And if you hold on to them for a short period of time, then, you probably won't have any capital gain or loss, assuming the stock doesn't skyrocket or drop. But if you hold on to it for a long period of time, you may have some capital gains or losses. If none of these things answers your questions, you can go to IRS publication 550, and there's a great deal of information there. The bottom line is that the IRS expects you to keep and maintain records that identify the cost basis of your securities, and you want to make sure you have these things before you get ready to make any trades or changes. So I hope this was helpful.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.